All right, everybody, welcome to IB Acquisitions, and we're here with Colin McNulty, who's a former SBA banker for a top 10 SBA firm, and we're going to be asking him some questions. And we also have Ansi Moncion. Can you hear us both?
Hey guys, how's it going? Thanks, Colin. Thanks for joining us tonight.
Thanks for having me.
Awesome.
Hey, bear with us, guys. We're in the studio. We're just dealing with some, internet outages here, so just bear with us. But nonetheless, welcome to the show, everybody. Let's get this started.
Absolutely. Just allow it a minute for the people to join because we want them to ask questions as well. And we should be good to go. All right, live looks good. All right, let's begin. Colin, as a lending officer specializing in SBA loans, can you give us an overview of the process and the requirements for obtaining an SBA loan for an acquisition? You know, I've seen a lot of people say they're going to go the SBA route, that is their go-to, but a lot of them don't seem to end up getting the loan. So what's the process and how can you increase your chances?
Yeah, so the process for achieving an SBA loan through an acquisition or for an SBA acquisition, it boils down mostly to really three categories. A, do you have the requisite background to run the business? If you're a highly specialized field, you want to make sure you have that highly specialized expertise.
Right.
I've been in banking for 18 years. I am not qualified to run very many businesses, but certain people are. So there are certain industries that it's a little less background's a little less relevant than others, but you want to make sure you have what's called transferable skills to run that business. That's first and foremost.
Right.
Second, does the business have requisite cash flow to support the debt that we're about to provide you? SBA lending can be used for a lot of things besides acquisitions. It's startups, it's real estate, it is debt consolidation. So each of those have their own little flair, but from the best chance of achieving an SBA loan from a bank for an acquisition is to make sure that the business that you are acquiring produces enough cash flow to support the debt that we will be placing on it.
Great.
And then the third piece is, do you have the requisite equity requirement, meaning you have at least 10% cash to put into the deal. You cannot borrow it. It has to be physically in hand in order for you to be able to achieve SBA financing. So those three things are your main starting points with any SBA loan.
Great. Now, Colin, before we get too deep into the weeds of the SBA lending process, let's just back off a little bit, right? And just tell us a little bit about your background, right? Kind of like your banking experience, how you got to where you are, and then we'll get a little bit deeper into the entire process.
So I fell backwards into SBA lending. I started out as a general commercial lender. My former bank that I was at for 10 years, I went over there, and starting in 2012, I had done one SBA loan prior to that. And I told myself I was never going to do another SBA loan again. Our group that I was in there ended up taking over the SBA group at that bank. And my boss kind of approached me and said, I'd like you to focus on SBA. And I told him, my experience wasn't so great the first time. And his commentary to me was, well, have you ever done it with anybody who knows what they're doing? SBA lending can be done technically at any bank in the country, but only a select group of banks do it well. Right. So I morphed from being a general commercial lender kind of around 2013. I started to do SBA by about 2016 or 17. I was probably doing 50-50 more traditional bank loans on half the time and SBA loans half the time. And through COVID, that probably bumped more to about 95% SBA versus 5% commercial. And that's why I've gravitated towards being a full-time SBA lender.
Perfect. Well, thank you for that, Colin. Now, let me circle back to what we were speaking about, the process. You mentioned those three factors. Let's talk about transferable skills. What if it's an individual who's coming out straight out of college, right? He has knowledge to some degree, but lacks that experience. Is there any way to subsidize it?
You can subsidize it there are means of doing it. One is going to be, depending on the business, is there infrastructure in place that minimizes that risk for you? Is there, corporate structure with people who run the business today? Is the owner vital to the business, or does he or she have staff in place that can really make up for your lack of transferable skills?
Right.
I'd also say your chances are much higher in the scenario that you just described. Less is more, meaning coming right out of college at 22 and trying to buy a business for $5 million is going to be judged a little differently than coming out of college and buying a business for $350,000. The perceived risk is obviously going to be higher on the larger deal. So, that transferable skill can be different for each industry as well. If it's a business that doesn't require a whole lot of specific knowledge, that's a little easier to be done than something like commercial construction or precision machining, which maybe has a little bit more technical background to it.
Right.
So, yeah, go ahead.
Let me push back a little on it. You mentioned coming in with a larger deal would be more risky as opposed to a smaller one. Smaller deals, generally speaking, tend to be more riskier. So are we talking about is the risk inherently in the business itself or the person that's going to acquire the business?
So every situation is a little different, but my commentary on kind of bigger versus smaller is the larger your SBA loan is, the more you're going to probably focus on the intangibles. Do they have some level of personal liquidity? Is the deal really strong? Any borrower, whether they are right out of college or they're nearing the end of their career, if you're borrowing $5 million on an SBA loan, independent of what the bank wants, just for yourself, you should have some level of financial wherewithal to be able to support that business. Anytime you buy a business, there's going to be a transition risk. You want to make sure you have some level of backup to support that risk. And if you're borrowing $5 million and you do not have any personal financial wherewithal, if that thing doesn't work immediately the day you do it, you're in trouble. Conversely, if you have a $400,000 deal and you, for lack of a better term, stub your toe, you can usually figure out that level of debt and still make it work. $5 million right now covers about $750,000 or so a year of payments.
Understood.
So, the bigger the risk for the bank, the more you're going to focus on the intangibles. Smaller deals, aren't necessarily easier to get done, but when it comes to someone who is doesn't have a lot of financial wherewithal themselves due to time and career,
right,
smaller is better, and then you can grow into that $5 million borrower at some point.
I like that. In regards to a starting point, would you say 1 million?
A lot of banks have $1 million of goodwill as a threshold, and by goodwill I mean uncollateralized loan. So
Okay.
if you there's not a right number there, though. Quite honestly, it depends on the person and the bank behind it. Someone could come out of college and have $400,000 of liquidity through inheritance or something, and have a house that they own free and clear through that same channel. That's a different borrower than someone who came out of college like I did with, a little bit of debt and nothing to their name. So there's not a right answer to that number. The better question, I think, to ask that is presenting to the bank why you feel you are able to support the debt, whatever it may be. I know myself coming out of college, if I'd have said I want a $4 million SBA loan, I would have been laughed at. I should have laughed at myself asking that question. So it really depends on the individual. There's not a right number that says this is the dollar threshold that you should or shouldn't go for. It really does depend on each unique situation.
Right. Okay. Let's talk about the last portion. You mentioned that 10% has to be cash, not a loan. I've heard people say, oh, what if you could come in with a bridge loan to seal that gap? Now, cash, can we use that term interchangeably with an investor coming in with that cash as opposed to your own? Yes?
Yes, for sure. Yeah, so the terminology used or the metric used is that you have to have that money available at least the last 60 to 90 days.
Okay, liquid.
So by that, if that 10% minimum threshold can come from the individual, It can come from an investor who owns the business, and you'll find different banks treat that differently. The physical rule behind it with the SBA is it doesn't matter if it came from the guarantor or from the investor.
Okay.
Certain banks will want the guarantor, meaning the proprietor, to have some level of financial skin in the game other than just their personal guarantee.
Right.
So there's not a uniform answer to that question, but yes, you do need to have that cash available. Bridge loan would be if somebody said I got a bridge loan to do this, I would say I can't do that loan. There's a 90-day look back. So if you got that bridge loan 4 months ago and didn't tell your bank, in theory, you could get away with it. But that is really pushing the boundaries of what the rule is. And I'd also always caution people, the SBA is a federal government-backed program. I don't think you want to skirt the rules too much on an SBA loan because of that fact. Not just to mention the bank, but also the federal government is backing that loan. So if you don't have 10% down and you don't have access to 10% cash through investors, family, and friends, then the mentality most likely should be, I should wait to do this. Not find a gimmick to get around the rule and then have it come back and bite you later.
Right.
Real quick, Colin, I know you and I discussed this a little bit,
Yep.
but not too in depth, right? Now, when it comes to the personal guarantee, there's a specific deal you and I kind of just overviewed on, right? Yep. And I think I was like, hey, so the personal guarantee, who are they going to look at, right? So I'm putting skin in the game. My investor's putting, obviously, majority skin in the game. But now, when it comes to that personal guarantee, a lot of investors do not like it.
That's right.
Now, let's just talk about just a little bit about that. What exactly does that mean, right? A personal guarantee. I know what it means. We all know what it means. But for our audience, let's just break down a little bit about what does that personal guarantee mean and what does it really look like for the ones who are actually signing that loan?
Yep, that's a good question, Ansi. So a personal guarantee, think of the perspective of a commercial versus a consumer loan. If you buy a house or you have a credit card, it's in your name, you're on the hook for it. There's a more couth way to probably say that, but for lack of a better term, you're on the hook. When you borrow commercially, the loan is actually to a business entity. So the borrowing entity is that business. But almost every small business loan in the country, whether it's SBA or conventional, has a personal guarantee behind it. And that is effectively that the owner of that business is saying to the bank, and in this case, the SBA, no matter what happens, I'm going to repay this debt. Again, the better way to say it is you're on the hook for the debt. The SBA's rule, and most banks follow this at the small business level, even without the SBA, although it's not 100% of the time. In the SBA world, if you own 20% or more of the business, you are required to personally guarantee the loan. So in the instance of someone buying a business and the equity is coming in from an individual who put in just, to make it up round numbers, they're going to own 25% of the business because they're putting in $200,000. Both the individual that is buying the business and the investor in that scenario are both on the hook. And there is no percentage based. You're both on the hook equally. So investors will highly unlikely that an investor would ever want to personally guarantee the loan, because not only is their equity at risk, now their personal net worth is as well if they guarantee. So in most instances, when there are equity investors, you might find one or two people who put in enough cash to stay below a 20% threshold of ownership. A lot of misnomers are out there about the personal guarantees. What you need to know as a borrower is you are on the hook for the loan personally. That's the easiest way I can say it. If the business fails for whatever reason, you don't just get to walk away and say, whoops, it failed. The bank has a fiduciary responsibility to enforce a personal guarantee on that loan and make sure that if you have the financial wherewithal to pay it, you have to, or the end result, if you don't, is likely going to be some form of bankruptcy.
So what does that look like on the investor side, right? So me personally, okay, I know what that looks like for me, right? But on the investor side, obviously they have a lot more asset, right? Probably a lot more liquidity than I am. So what does that look like for them? Is it going to be more so real estate asset that's attached to it, or does it not matter the kind of asset?
So it depends on if they're guaranteeing the loan or not, Ansi. So if you have an investor come in and say they want to own the business with you 50-50, and the individual that's buying the business and is going to run it daily doesn't really have a whole lot of personal financial wherewithal, and the investor does, and something went haywire and the deal failed, the bank is going to go right to that investor first and say, you need to find a way to pay us. The bank will almost always take the path of least resistance. Of course, we're going to say the same thing to both people, but you're going to go to that individual and say, if you have stocks, liquidate them. If you have cash, pay us. If you have real estate, sell it. The personal guarantee that, again, occurs in almost all small business loans, not all, but almost all of them, but 100% of SBA loans, is a very real risk for an individual. It is why investors almost never personally guarantee and will stay below a 20% threshold, because they know that they're the likely person who's going to have to pay us off if something goes bad. Does that answer your question, Nancy?
Yeah, absolutely.
All right.
Absolutely.
Great. Let me hop in there. What are some key factors you consider? Now, I'm speaking on a personal level, such as credit score, personal background, financial history. Does that matter, and to what degree?
It definitely matters. There's a minimum credit score, which typically you see it kind of in the 660 to 680 range. Most of the time when you're getting an SBA loan, the assumption is going to be that you have decent credit.
Okay.
The kind of asterisk to that one is if you have something like a medical collection or some kind of a mistake, if you will, that was remedied from months ago, but still depresses your credit. So personal credit matters, but it really is assumed you're going to have decent credit if you're looking to borrow a sizable SBA loan. Financial history, personal background. If I had to put a number to it, I would put 80% of the process is based on the company that's being acquired, and 20% is on the individual behind it. With the individual behind it, you want to say the three things I said earlier. Do you have requisite experience? Do you have some financial wherewithal? And where's the equity coming from? But the bulk of the deal is going to be based on, does this company that you're buying produce enough cash flow consistently to pay the debt back, pay you a new salary, and have some left over? No one wants to work just to pay a bank back. You want to make sure there's enough spread there to be able to have profit on top of that as well. But honest answer, the assumption is if you're coming to a bank for a commercial loan, your personal history financially is going to be pretty clean, with a couple of exceptions.
I appreciate that. Let's talk about those exceptions. But something else I want to talk about in regards to the people that seek out these type of loans, are they mostly owner operators?
Yes. So an SBA loan has to be for an operating business. You cannot use it for apartment buildings, strip centers you're renting out. SBA loans typically fall into four categories. It's going to be a business acquisition, a real estate loan, and I think those two, if I remember correctly, make up about 80% of SBA loans. A startup, franchise or non-franchise, or debt consolidation. There are other things that kind of fit in there, but the bulk of SBA loans fit in those four categories.
Okay, understood. What I meant by owner-operator term is, are they involved in the day-to-day of the business?
Yes. So you're supposed to is probably the best answer. There's a lot of gray area in SBA. There are certain things where, I'm looking at a loan right now where a guy's going to keep his day job and buy a business because he can dedicate half of his time to it.
Right.
In theory, that is supposed to be an operation that someone runs and is going there every day. There's a little bit of gray area within that, but yes, it's supposed to be an owner operator type of operation. It is not meant for passive investment.
Okay, understood. In regards to deal size, SBA usually tends to be 5 million. I've seen Live Oak push it about to 7. But some of these individuals employ structures that usually involve seller finance. So say it's 5 million and I'm doing 5 million SBA is a $10 million deal, 3 million seller finance, $2 million earn out. Would that go?
You can't do an earnout within the SBA, and there's some gray area as we speak. About a week and a half ago, the SBA put out new language that is going to make a pretty big impact on how lenders move forward. Previously, you had to, as an entrepreneur buying a business, buy 100% of that operation.
Mm-hmm.
You could not have an earnout, and the seller had to exit the business within 12 months. That's been a staple in the SBA for forever, as far as I can tell. Last week and a half ago, they put out language that said sellers can now roll equity into the new operation. Practically speaking, I don't know what that means yet. All banks are still digesting it. It doesn't take effect until May 10th.
Right.
But I don't think it'll, and this is my opinion, it's not language yet. I don't think earnouts will still be allowed, because what the SBA doesn't like is a change in the original purchase price. So what you end up seeing is you had what a lot of people would count as a reverse earnout, but that's really a seller note that had contingencies attached to it. I don't think earnouts will still be allowed, but the typical structure you're talking about there, if it was a $10 million deal, what I've historically looked at is you'd see 5 of SBA, 3 of seller note, that's contingent of some kind possibly, and 2 of equity. The loans you're referencing above $5 million are what's called pari passu lending. And so you have a $5 million SBA loan, and in the $7 million case, you have a $2 million conventional loan side by side. And in the event of a default, those two situations, or those two loans, distribute the collateral equally. Very few banks do that. It's not right or wrong whether you do or don't. It's just a different type of lending. And it is it's a pretty, SBA loans generally are risky and high leverage situations. So pari passu lending can be a good deal to make get you over that threshold, but you do have to be careful. You're a really highly leveraged business when you're typically doing that.
I see. You mentioned we as buyers, usually it's preferred to buy 100% of the business. So that would exclude any equity holds, correct?
Well, not necessarily. So you mean in terms of the buying team?
No, the seller. Say the seller retains 20% equity.
The seller has had to exit 100% until May 10th of this year. So we're still digesting what the language is on that. There's a conference going on as we speak for our, kind of our trade association called NAGL. They are supposed to disseminate this information down to us. My gut would tell me even on May 10th, a lot of banks aren't really going to know how to marry that up with their credit policies. But in theory, what it now means is when you acquire a business, the seller can remain in the business as an equity shareholder. In what respects, we don't know yet. We don't know if that means they have to personally guarantee. Those are the things that are still being vetted out. But I'll tell you the rule as of April 26th. The buying team, might be the better way to say it, has to buy 100% of the business. And the selling team has to exit today. That is a very strict rule that the SBA has. What they don't want is deals changing post-close. So seller notes are okay because at worst, it's the exact same. At best, it depresses the original purchase price.
Right.
But earnouts are not allowed today.
Understood. So it seems like ANSI is having a little technical difficulty. We'll be back in a few minutes, but we'll continue. So how do banks typically use Ebitda multiples in evaluating loan applications for acquisitions? What's considered a favorable multiple? I've heard do not exceed 5.
It depends. I mean, the industry drives that. The bank shouldn't really be the determining factor in what multiple is paid. Okay. What typically determines whether the deal had the right multiple to it is, does the cash flow work on the business still? The higher the business is up the food chain, and by that I mean the higher the Ebitda, the higher the multiple typically is. Industries drive multiple, as do size of deals. There's not a right answer to that. You're typically seeing, most of the deals I end up seeing kind of are in somewhere between 3 and 5x on the multiple. But it's important to talk to your bank about what that means, because there's more to the deal than just the multiple paid. What you got out of that acquisition, for instance, if you're buying a manufacturer, you're going to have inventory. You're going to have working cap. You're going to have receivables. You are going to have possibly WIP, work in progress. If you don't get those things at close and you only pay a 2 multiple, that sounds great until you realize your effective borrowing is the equivalent of 5 multiple. So there's more to it than just the multiple paid to answer that question. So, certain industries, I looked at a dry cleaner or a coin laundry a few years ago, and the multiple was like 7x or 6.5x. And I was like, you're never going to get this. Sure enough, that's what the multiple was in that industry, because it's a passive income type of business. So the industry and the company itself, size of the company itself, drive the multiple. But the better way to answer your question is, if you pay too high a multiple and you don't have the requisite equity, the deal won't cash flow. So it won't matter what you pay. It can't get done because there's not enough cash flow to repay the debt you're trying to leverage the business at.
I see. Are we seeing higher multiples on average?
Right now, no. I don't know. The higher interest rate market has made that even more difficult. A typical SBA loan in 2020 to 2021 was kind of in the mid 5s. Right now, you're seeing that rate kind of in the mid 10s. So interest rate is driving down the ability of people to leverage the business at 90% like they used to. And I haven't seen a drop in multiples yet. There's always the needle in the haystack where somebody got a deal, but I haven't seen that drop occur yet.
If you don't mind me asking, what's the usual activity for an SBA bank on a quarterly basis? How many deals do you think are getting funded acquisition-wise?
It depends on the bank and the types of deals you do. The big volume players are doing hundreds. The typical bank, like the one I work at, you might see on any given month, I'm trying to back into the number based on our goals, but you might see, somewhere between $5 and $10 million a month of SBA loans going out. That in 1 month, that might be 5 deals, and in another month, it might be 10. It just depends. A lot of banks have certain thresholds of sizes that they go to. So I would say the cop-out answer is there isn't a typical number at any given bank.
Understood. The usual time frame, what would that be for a loan? 10 years?
As far as the payment amortization?
Mm-hmm.
Yeah. So a business only acquisition is 10 years typically. Some banks that are more conservative will push that down based on whatever metrics they have, but the maximum you're allowed, what most true SBA shops play to, is the 10-year on a business acquisition. If there's real estate, if an existing business was buying a building, for instance, that would be a 25-year term. If you're acquiring a business and the associated real estate, talk to your bank before you put the LOI out, because there are very different levers to pull there in terms of how you can do that most beneficially. If you're buying a business and building for $3 million, for instance, combined, and the real estate is $1.7 million and the business is $1.3 million, you can do that entire loan over 25 years because the real estate is more. If it's reversed and it's $1.3 million building and $1.7 million business, the likelihood is going to be you're going to have a blended amortization of 17 years. You can also buy the business with SBA 7A money and the real estate with a different product, be it 7A, be it 504, which is another type of SBA loan, or conventional bank financing. So, you have to have a bank that is willing to talk to you about everything, even if it's not to their own benefit. But the long-winded answer of saying yes, a business acquisition only loan maxes out at 10 years.
Great. Thank you, Brad.
Mm-hmm.
I don't know if you have these stats, but I'm curious. In regards to people that seek out acquisitions, how many of those deals would you say come from a business broker as opposed to individuals that nurtured those leads themselves?
I don't have those stats, but kind of my own opinion is, if I'm to throw a number on it, just on deals I look at, I'd bet north of 75% of deals come through a brokerage network. Typically, a proprietary deal where there's no broker is going to be the ones I've done. It's going to be a key employee buying the business. It's going to be somebody who knew them somehow, or another business buying a similar business out.
Mm.
You have the occasional person who found a business. That's not unheard of, but it's fairly rare. You think of the cycle of someone selling their business. You might have an individual who owns it for 40 years.
Right.
And you got to catch them at the right time that they want to do that. Well, your thought would be to try to find that needle in a haystack, is to just call people like crazy. Well, what are the business brokerage community doing?
Right.
They're calling people like crazy and have a system for it. So I would think, outside of kind of an internal acquisition, I'd put a guess it's well north of 75%.
Great. I got a question. Say I want to become a business broker the day of tomorrow, and I want to start building these relationships with SBA banks to refer my clients. Can I get something from a referral?
You can. So we can pay referral fees through closings. Typically, it's a percentage of the SBA loan.
10% of the SBA loan?
It's a percent, a certain percentage. There's no rule on how much. No, otherwise you're starting a business brokerage tomorrow, huh?
Right.
So there's no rule. I mean, there's probably a cap on it. I don't know what it is, but it might be a good idea for you to show you why this happens too. So the way that banks make money in this space, most banks make money in this space. You have two options with an SBA as a lender to make money. You either hold the loan on your books like any other commercial loan, and you make interest over time. That's what you see a lot of large banks do. Most SBA lenders that are doing acquisition financing sell the guaranteed portion off and make a fee off of that. So when we do that, we have a significant amount of income that comes in from that. We can pay brokerage fees. Anybody can technically, but that's where it makes financial sense. So to put a number to it, if I was to close a $2 million loan, the guarantee portion of that loan is $1.5 million. There is a very robust secondary market that will pay us a premium to buy that guarantee. So we would, the borrower never sees this. It's all on the back end. So we package deals, we sell it off. Somebody buys that loan for $1.5 million. They might pay us $150,000 for it. That's how banks make money on SBA loans when they're doing things like acquisitions. There's, like I said, some banks hold them and keep them long-term, but there's a very lucrative secondary market, which makes these deals very attractive to banks.
Hey, you piqued my interest. Let's dive a little deeper if you don't mind. How did this work? Explain it to me in simple terms, because I got caught up in the details. But that selling off that portion of guaranteed income, how does it work? And the holding it longer portion you mentioned as well.
Yeah. So I'll do those in reverse. Holding the loan itself. Nice. I'll use a $2 million loan. Some banks choose, and most of the time this is more for highly secured deals, real estate, smaller deals, whatever it may be. A bank can decide, what, I'm floating this rate or I'm fixing whatever it may be. I'm at 10%. Okay. I can make money holding this loan off of this for 10 years. Okay. So that bank may choose to hold it. The majority of 7A loans are done this way, though. And I think I said this to Ansi the first time I talked. Banks almost always have the biggest building in every city. There's a reason. Banks usually know how to make money, banks and insurance companies. So the banks are able to sell the guaranteed portion of the loan, which is 75%, on the secondary market. There's a robust group of buyers. These are people, companies you would know, kind of the big investment houses. And they on the back end package this as investments to their team. So they pay a premium on those because it is an almost risk-free investment. And so the way it works is a bank does a $2 million closing. The SBA loan is $2 million. A week and a half later, we sell off $1.5 million of that loan, which is the guaranteed portion, to an accredited investor. The borrower sees $2 million as their loan amount. Nothing changes. The bank still services it. It's just a back-end piece that's sold off. They pay us a premium for that. Their only risk in the deal is that the loan goes bad or is refinanced prior to them recouping their investment. Because if the thing goes bad, if the deal goes bad, we have to buy it back. You'll find very few SBA lenders will explain this to you because they don't want you to necessarily, or, I don't want to speak for everyone, but they don't really want you to know how the money's being made on the back end. I'm a very full disclosure person, you will find.
I
Now,
appreciate that.
that big fee sounds great, and it is great, but keep in mind what the bank is doing. It is a highly risky deal because that $2 million deal, we have a $500,000 potential loss in it, assuming we did everything correctly in the SBA honored or guarantee. So even if you make 150 on the sale, you're still exposed to 350,000, which is a lot of money, even at a decent sized bank. To take a couple hits on that, it would be painful. So while there's a lot of money to be made, there's a lot of risk that's associated with it too.
Okay. I'm assuming that risk is at the bank level because you mentioned these individuals that are buying these loans, they have no risk. How is that so?
So if the loan stops paying, what we call goes non-accrual, we have to buy the loan back for whatever they owe. So if you have a $2 million loan, you sold off the guarantee, and say 3 years into it, the loan stops paying, and the balance is still $1.6 million. Well, at that point, the bank has 400,000. The investors have $1.2 million. If they stop paying, we have to pay $1.2 million to get the loan, to bring the loan back into it. There's a much more complicated process.
Right. What type
so
of
their
returns?
only risk? Pardon?
Sorry, you could finish that, but then my follow-up question is, what type of returns they're seeing for buying these loans?
So the type of returns for whom?
Right, these individuals that are buying them at a premium. Why would they do
so
that?
what they're doing is they're gaining that interest. They want the 10.5% interest floating over 10 years. So that's what they're willing to pay a premium for, is that revenue stream. And it's very lucrative.
Okay.
If the loan stayed in place for 10 years, they would make a ton.
Okay, let's go a little more back and forth on this, okay? If you don't mind.
Sure.
Modeling this out in risk to reward comparison for the bank and for these institutions, I'm assuming these institutions, which are the ones buying the loans at a premium, are making more over time than what the bank would. But I'm also assuming that the bank sells it in order to recoup investment or capital and redeploy it in other loans. Correct me if I'm wrong.
That's right. Yeah. So this is very inside bank baseball, and it's well above what I do at the bank. So any loan that's on the bank, there's an allocation of capital that has to be attached to it, depending on the risk and whatever else is involved in it. When you sell off that guarantee, you don't have to allocate the capital associated with it. So a lot of banks that are in the SBA space that are specifically just SBA lenders don't have the capital base to hold those loans, even if they wanted to. So they have to sell off the guarantee. They're built around that. None of this, if I'm going to be 100% blunt, is relevant to the borrower, quite honestly. It's all back end of it. It's more of me explaining why these deals are lucrative to banks, why banks like doing them. Right. And the real relevant piece for your borrowers are, you will hear banks, people in my role, tell someone you cannot fix an SBA loan. They'll say you physically can't. That is not accurate. Most banks will not fix an SBA loan because there's no secondary market for it. If you fix an SBA loan, you essentially have to be in column A, where you keep it for 10 years.
Explain the term fix.
Fixed rate is just like think of a 30-year mortgage. Okay. Most SBA loans float based off of prime, some kind of spread over prime.
I see. Actually,
and that has gone up dramatically in the last, 15 months or so.
Yeah, we're gonna touch on that. We got a question from the guest. He said, "Hello, has anybody found any countermeasures to the variable interest rate on existing 7A loans? Mine are up 40% in the last 7 months."
Yeah, there really isn't. There are banks who do fixed rate SBA loans. Historically, what you see is those are going to be higher quality is not the right word I'm looking for, but higher capital, their real estate deals, or their loans for, say, $400,000, where somebody has a house that's pledged that's $1 million, something like that. But it all depends on the bank structure. I'd have to guess the vast majority of loans are floating because the banks want to sell these on the secondary market. So you're not really protected in that respect on the floating rate. We got spoiled for whatever it was, 20 years of cheap interest rates.
Right.
But 10% isn't the end of the world. I think what really happens, like your question said, was it happened fast. It wasn't like it went up a half point a year for years. It was quick and it hurts. And you're really just starting to see that because most of these loans have quarterly adjustments. So as prime went up, I think 2% in fourth quarter, those payments didn't kick in until January. So we're really only 3-4 months in, 3 or 4 payments into that higher interest rate environment. And that's really starting to bite. You can tell on borrowers asking the exact question. What I would say to your audience here is part of your discussion with the bank when you're doing this should be rate sensitivity. I mean, we were at a very historically low interest rate environment before COVID, and then they dropped it down to basically zero. So deals were getting done that didn't cash flow great as it was. And this isn't specific to any one deal, but just generally what my assessment of the market was. People were doing deals that worked at barely worked at 5.5%. So as rates ticked up, I'm the first one to tell you I never would have guessed in 1 year they would have gone up over the double digits. But the assumption should have been rates were going to go up kind of in the 7 and 8% range instead of 5.5 over time. The problem was it happened so fast for people that they didn't get caught up. And that, nobody predicted that, but you should have predicted as a bank that rates were going to go up at some point over, it's a 10-year term you're getting yourself into. So interest rate risk, inflationary risk, recession risk, all should be discussed before the loan's ever signed with your bank.
This is the first time I've heard this. You mentioned the term rate sensitivity. Did I hear that right?
Correct.
Okay. Explain that to me, please.
Yeah. So when a bank is underwriting a credit, you're supposed to, I think it's a rule, but maybe it's different with every bank. But what we do is we add 3 points to the current rate to see if the deal still works. It doesn't have to work great, but that they can still function essentially. So right now, if you're floating a rate at 2.5 over prime, that's 10.5%. We're going to do the loan and underwrite at 10.5, but we're also going to test what it would do if the rate was 13.5%. That sounds crazy, but it sounded crazy to go from 5.5 to 10.5 too in a pretty short time. So the bank has a sort of a fiduciary responsibility to test that and see if it effectively can't be paid at that point. If your company cash flow, and you're judging off historicals when you do these deals. So if there isn't a period of time where you can absorb a 3% interest rate hike and at least make your payments, then you have to question, should you be doing that deal? It went up 5 points, so nobody really anticipated that. And I don't think many people tested at 5. But if you didn't do some level of rate sensitivity, then it kind of wasn't to the benefit of the borrower at that point.
Right. Let me ask a follow-up question. Is this kind of similar, or does this relate to quantitative easing?
Two different things, and I'm not an economist, so I'm going to really go outside of my comfort zone to say this, but quantitative easing was the Federal Reserve buying government bonds to get liquidity into the market. Okay. So they're two different things. Interest rates are typically done to combat or increase inflation. Okay. So what the government saw was that inflation was going crazy. You can go to whatever reason you believe that happened, but they said inflation's out of control. The way you get inflation under control is you raise interest rates and depress borrowing ability, so people think twice before they go on a second vacation or buy that car. You can probably guess that all the stimulus through COVID and right after COVID created kind of a lot of cash in a lot of people outside of specific industries weren't hit that hard with COVID. Most people, there were certain industries clearly that were hit, but most of it was short term, but that money is still in the system right now. And it's just sort of bleeding out as we speak. So they raised rates to try to depress inflation, but that's why it's gone up so much, is it hasn't worked yet. So no, that the two are kind of all of it is in the Federal Reserve's wheelhouse, but they kind of serve two different functions.
All right, I'll be right back. Give me a moment. Nancy's going to take over.
Yep.
Yeah, this is a question. This is a question from one of our guests.
Sure.
Um, they said, why would someone prefer to use cash flow based slash asset based lending as opposed to the SBA? And it's kind of a two-part question, but
Yeah.
I'm gonna just let you get to that first part.
Yeah. So the important thing, cash flow lending at banks is very difficult until you get to a certain threshold. You might hear different banks say different things, but the basic gist is once you get to about 5 million of EBITDA, you can start doing what's true cash flow lending, where you can put a multiple of that EBITDA on your debt stack. That's where you start to see more private equity, family office type deals happen. There are banks, I'm sure, who go below that threshold, but most banks in this country can't finance a $1 million EBITDA business that has a collateral shortfall without the SBA. Your asset-based question is relevant because when you have assets to cover the loan amount, and this is at an advance rate, which I'll explain in a minute, you don't necessarily have to use the SBA at that point, but it's pretty rare that you find those. If you're buying a business, especially, the seller is traditionally going to expect a multiple over the cash flow they produced on top of the assets. So if you're buying a business that say is $1 million of EBITDA, a manufacturer with $1 million of EBITDA, and they've got a $2 million building, they're likely going to want 4 to 5 million for the business and 2 for the building. So you're going to have a collateral shortfall, and that's what the SBA does. It sort of functions as an insurance policy against bank losses. So the short answer to your question, and anybody in credit hates that I say this, most of the time in an acquisition, you do an SBA loan because you have to. There isn't another option to avoid that. The SBA has pluses and minuses, but in a lot of instances, you do the SBA loan because that's the only option that actually exists.
Okay, great. So the second part of the question is, so cash flow based lending tend to have less covenant and can typically close quicker than SBA lending. Now, what are some pros and cons to that? I myself, I'm familiar with cash flow based lending. We have about 12 banks that we reached out to for a prior deal, but they tend to have less covenants and can close quicker. Now, but doesn't that typically mean you're going to be, they're going to issue out a much higher interest rate as opposed to the SBA? Let's just touch on that a little bit for our guests.
Yeah, it can. So cash flow lending can be done in certain industries, certain sizes, but I don't think you'd see less covenants. Typically, you'd see more covenants and more restrictions because the SBA loan really usually doesn't have any covenants. As long as you make payments, you're in it. And for those that don't know what a covenant is something the bank puts into our loan documents to measure the success of the business. You typically test it monthly, quarterly, or annually, or all three. And if you miss a covenant, like a debt service coverage covenant or a balance sheet leverage covenant, you technically can get put into default and the bank can make you exit. Under the SBA, most banks in this space, as long as you keep paying them, you're in compliance of the documents. So the covenant perspective is usually easier on a 7A. The speed to close probably is faster within the non-SBA leverage banking situation. But to your point, you're going to have probably a higher interest rate. You're going to pay a fee that's pretty comparable in most instances to the 7A loan. And you're going to have a much more complicated structure. Additionally, and I don't want to speak for you, Ansi, and the deals you've done, you're also going to find you have to put a lot of cash into that deal. Whereas an SBA
Absolutely.
loan, yeah, and you can, typically a private equity transaction, again, these are different bank to bank, you're going to see 30 to 40% equity in those. An SBA loan you can put in as little as 10.
So now, lastly, right, we're about to wrap up the show here.
Yep.
We have a lot of questions, in case you didn't know, but I've seen people have issues raising 200,000, 250,000, right? How often do you see people with such a little amount having issues raising or getting that from the bank? I know I myself, like I had a deal, we needed 600,000. It was like really hard. Like we had some banks that were like, look, you need 4.5 million. We would rather finance a 4.5.
Yeah.
Instead of the 600,000. So how often do you see these small loans, and do they typically get done quicker as opposed to a large amount if you need from the SBA.
And sorry, you kind of cut out on me a little bit there. I didn't hear all of it, but the equity raise is traditionally built off your network. Ideally, I don't think the SBA was designed for what it's used for a lot now, which is like professional investment going into it. I think the original kind of setup was family and friends were able to support a business owner. But as these deals have gotten bigger and more complicated, you tend to see professional money coming into them. So you have to be able to attract that investment. And that's either through a network that you have or through some kind of an offering that you're putting out that attracts an investor to put money into it. So, I've seen people raise $1 million from 15 different people. I've seen people raise 100,000 from one person. I don't typically see where I'm involved in the raise too much, but a year ago there was a lot of money to invest. I bet it's getting a little more, and people had to place money somewhere that they felt like they could get a return. And a bank CD right now probably pays 5% with no risk. So if you're going to invest in a business, you got to hope that you're going to get, a multiple over that to take on that level of risk. So I would think, kind of to your question of do multiples get impacted, I'd also think that equity could be tougher to come by because there's now safer investments that actually do pay an okay return on them. I don't know. That's really the answer you were looking for, Ansi, but that's the answer I gave.
No, that's great. That's great. Again, we just have a lot of questions from our guests, and we're just trying to take, as many from them as we can.
Yeah.
Valentino, are you seeing some questions that
Yeah.
you'd like to ask?
I want to ask something in regards to how banks assess these acquisitions for the risk. Are DCFs done? Or what approach?
DCF, can you explain that for me? I'm sorry.
Discounted cash flow models. Are they applied to value these businesses, or what approach do you guys take?
So what we tend to do in these is you're looking for a debt service coverage ratio. And what that is your annual income as a numerator and your annual total payments as a denominator. And every bank has a little bit different number here, but you kind of want something between 150 and 2% and 2 times on that. Okay. So what you're going to do, where these acquisitions, the easiest acquisitions to do or to underwrite are going to be where the true EBITDA of the business, the net income, depreciation, amortization, interest, and if I said, I don't know if I said depreciation or not, but those are easily added back. And in most of these instances, the sellers of these businesses take out a larger salary than the buyer is going to. So you add back that difference. If the seller's taking 400 and the buyer is only going to need 100,000, you can credit that 300. That's your numerator. Your denominator is 12 months of debt service, either SBA loan, seller note, whatever else it may be. The tricky part in these deals, especially with small businesses, is most small business owners treat their company as a piggy bank. And they've got a credit card, they've got travel, they've got meals and entertainment, they've got 4 family members on there. And most sellers want to try to capture that in that EBITDA, or that, the bigger the number they can get, the higher the amount they get because of the multiple. So that's where it gets cloudy in a lot of these deals, is not the EBITDA or the seller's comp, but all the other add backs that are added to try to get the multiple to that point. That's what makes these deals complicated. A true EBITDA plus owner's comp deal, you can figure out on the back of a napkin in about 3 minutes whether that's going to happen or not.
Great. Lastly, to finish off, what role do lending officers play in the negotiation process during an acquisition, and how can they add value to a deal?
So we should not be making an opinion as a bank. This is my opinion. It's not necessarily a bank's opinion, but I don't think I should ever tell someone you're paying too high of a multiple. That's not my expertise. What I can say is the cash flow doesn't work. So if you're going to pay a higher multiple, you have to put more equity in. The way a bank, and where I personally try to differentiate myself from the rest of the pack, is if you come to the table and say, hey, Colin, I've got this deal already negotiated, the LOI is signed, I've got this, what's your best deal you've got? And you send it to 12 banks. Of course, I'm going to talk to that person and be involved in it, but I haven't added anything to that mix. I'm typically just a commodity at that point. The way to have your bank be beneficial to you is to get them in early, go over the sim with you, discuss options that exist, understanding the rules around things like seller notes, how you can structure those to your benefit, what industry knowledge that person brings to the table. That is where the bank can differentiate itself from just being part of, any other bank. The actual closing of an SBA loan itself, typically isn't that hard bank to bank. We all do it. So you wouldn't be in business if you weren't closing loans.
Right.
Adding a certain level of value up front, especially as it relates to things like working capital need, capital expenditures, opinions on industry concentrations, whatever it may be. That's where you can add some value to your customer's process as opposed to just being a number.
Right. Colin, thank you very much. You've been amazing. Hopefully in the future we can bring you on again. I know people got questions every day and the environment changes, but we appreciate you being on.
You got it anytime.
Not only that, Colin, we have a couple, as you know, we have a couple people who's actually looking.
Okay.
They have active deals right now. When is the best time to get either yourself involved or their banker involved in the deal? Is it as they structure the LOI, post structuring the LOI? When is the best time to bring in a banker?
Talk to your bank before you send an LOI out. My goal is always to come up with something that benefits the borrower. It doesn't always happen, but it could be an industry experience. I could have a knowledge, your bank, if they're doing this type of work, has likely closed, 20 to 70 of these, and they've probably looked at a multiple of that. So I have seen a lot of different things over the years, and whether it's industry, whether it's geography, whether it's multiples, I don't necessarily jump in and say, here's what you should do, but my job in this is supposed to be somewhat negative. I'm not the person who's